In acquisition analysis, if the cost of acquisition is greater than the fair value of identifiable net assets, the excess is recorded as goodwill on the balance sheet. As an intangible asset, goodwill arises upon the acquisition of the company for greater than the fair value of its net assets. The difference tends to stem from future benefits that are not individually identified and recognized in acquisition, such as brand value, strong relation with customers and employees, etc. According to AASB 136, goodwill is subject to annual impairment review, where an impairment will occur if the goodwill's carrying value is greater than its fair value. As acknowledged by the article itself, had UPS properly valued freight, its earnings and other reported items would have been materially lower. Consequently, one major risk in impairing goodwill long after the underlying deterioration of the business lies in misleading investors and analysts in any consequent evaluation or investment decisions they may choose to undertake. Delaying impairment recognition risks inflating the true earnings and reported items as aforementioned, as these values directly affect key metrics utilized to determine financial position, such as ROA, and earnings-based valuations that determine financial performance, such as PE. This risks overinflated financial statements that distort investors' perceptions of what to pay for its shares. This is seen through UPS's own delayed impairment recognition, which overstated freight's total assets 3 times the true amount, and would consequently render the key metrics to determine financial position as misleading.
As stated by Dominique, under Australian Accounting Standard 3, goodwill is the recognised difference between asset group's consideration price and net fair value, representing a premium for an asset's unidentifiable intangible properties. The unrecoverable intangible benefits recognised in a goodwill impairment informed by internal future cash flow projections reduce profit and net assets by creating an expense and increasing the balance of the accumulated goodwill impairment contra account. Given the annual impairment testing required under AASB 136, as explained by Dominique, disclosures may expose poor acquisition performance according to Raj Gopal, leading management to delay goodwill impairments to avoid scrutiny. Substantial delayed goodwill impairments cause significant fluctuations in a company's profitability and may signal to external financial report users that assets have underperformed or been mismanaged. This may decrease shareholder confidence through reduced expected earnings per share, potentially reducing investment and negatively reflecting on management's performance. Lee et al., in a study of 1,584 companies between 1996 and 2006, found that companies with unexpected goodwill impairments experienced an estimated 2.45% greater decrease in announcement quarter earnings per share compared to other companies. Since these metrics often influence management bonuses, delaying goodwill impairment may help management secure time-bound bonuses. Furthermore, Roy Chowdhury and Martin argue that management may delay goodwill impairments to offset against positive cash flows and/or a period of weak financial performance to improve the company's future profitability results. For example, in the second quarter of 2024, Paramount Global recorded a $5.98 billion US goodwill impairment for its cable networks, contributing to a $5.4 billion net loss. However, this coincided with the company's announcement of its first streaming profit in a direct-to-consumer division. Thus, the company's share price increased by over 5% shortly after, suggesting that shareholders were unaffected by the goodwill write-down.
Thanks, Lachlan. Now we will go through key lessons regarding the article. The article utilized the UPS 6 billion goodwill impairment as a textbook illustration of how recurring M&A failures compound over time, causing lasting effects. The 2005 acquisitions of Overtime Transportation, a less than truckload carrier, later rebranded to UPS Freight, will be the primary case study, and it highlights how flawed M&A strategies, failed integration, and weak financial governance can all converge to destroy long-term value. Firstly, acquisition strategy. UPS acquired Overnight Transport for $1.25 billion at a 42 to 46% premium. At the time, the UPS chairman referred to this acquisition as a perfect strategic fit, optimistically forecasting its expansion into the LTL segment. However, this acquisition was built on overconfidence, and the expected synergies between the two companies failed to materialize due to misalignments of the parcel-to-customer structure of UPS and the low-margin, capital-intensive LTL market. UPS misjudgment caused almost $500 million worth of goodwill to be impaired, and the business was sold to TFI International in 2021 for $800 million. As Rajagopal critiques in his article, the CEO recognized that a deal will not materialize, but due to the overpayments for the acquisition, they will delay the write-down of goodwill impairment, causing a catastrophic end for the organization. This is reinforced by Lee et al. 2011, who indicates that goodwill impairments stem from acquisition overpayments. Hence, it is safely to say that the key lesson here is do not let the strategic excitement override realism. Any acquisition must fit our cost strengths and operational model.
Following the poor acquisition, UPS also failed to successfully integrate the businesses, with the management of unionized labor and stringent contracts being the central challenge. The LTL segment was intended to optimize routes, improve delivery speed, and introduce technological upgrades similar to competitors like FedEx or Old Dominion. However, with approximately 60% of UPS Freight employees being union members, UPS had to deal with strict labor rules and higher costs, which blunted any real efficiencies of the LTL. So instead of creating synergies, UPS was stuck with operations that could not be integrated with their core parcel business, eventually slowing down operations. The sale of the business to TFI International in 2021 for less than half the price it paid for during acquisition substantiates the underperformance and inability to integrate the businesses. The main takeaway is that businesses should not assume immediate integration and ensure that real synergies align with existing labor, systems, and culture. Now moving on to financial reporting. The GAAP requires UPS to use a $650 million in total valuation of UPS Freight to calculate its write-downs. However, UPS relied on an external valuation that overvalued the business by 3 times, thereby misreporting the actual figures. As argued by Romana and Watts, this misconduct is a typical issue with impairment rules, which gives too much discretion to managers to decide on the fair value of their business. As a result, it incentivized the delay of their goodwill write-down to mask underperformance and warp investor optics. This reveals a broader governance issue that stems from a lack of reporting oversight and transparency, which resulted in a $45 million penalty for improperly valuing the business unit in 2024. So what can we learn from this? Ultimately, delaying impairment recognition only postpones the inevitable, worsening investor trust and causing long-term damage. Transparency and timely reporting is essential to accurately represent business performance. I'll now pass it on to Paul to discuss the early indicators of future write-downs.
Hello. In this section, we will explore how analysts can examine disclosures about acquisitions performance to obtain early indications of potential write-downs. Notably, we will be highlighting how firms with greater than US $1 billion in goodwill and intangibles and a market-to-book ratio under 1 are, quote, classic write-downs waiting to happen candidates. We will also be looking at other key warning signs beyond the upfront data to highlight key insights into how and why firms delay their write-downs, to get more accurate readings as to when write-downs will actually happen. Having a greater than US $1 billion in goodwill / intangibles and a market-to-book ratio under 1 is a valuable early sign for analysts of a potential write-down. Rashgopal highlights that a market-to-book ratio of less than 1 suggests that the stock market is publicly asking the CEO to take a write-down. As such, this ratio serves as a predictive tool to flag firms which have overstated acquisition-related assets. However, such data has limitations that they only broadly signal towards impairment risk, but doesn't tell us exactly when. This is particularly notable as there is generally significant delay between what management knows internally and what is disclosed externally, leading to potentially postponed impairments. Analysts can anticipate write-downs by examining disclosures that hint at underlying issues despite seemingly outward success. Companies often delay impairments due to reputational concerns or internal bias, as write-downs are typically considered an ego blow for executives. For example, UPS's internal valuations had placed its assets at a fair value at $650 million. Despite this, the company continued to carry $1.15 billion in goodwill because of more favorable third-party valuations that placed its value at $2 billion. This highlights that analysts must look beyond headline figures, instead scrutinize management discussion, impairment footnotes, and assumptions used in discounted cash flow models, as overly optimistic projections may signal impairment avoidance. Thank you.